Good evening, everyone. Can you please confirm whether I'm audible?
You're audible.
Okay, thank you, sir. So, good evening, everyone, again. I would like to welcome you all to this special guest lecture on value-added tax, which is an important area in ACC 3374 taxation course. So, today's guest lecture is conducted by Mr. Nadika Suranjana, and now let me introduce him to you all. With a distinguished career spanning over 13 years, Mr. Nadika stands as the senior tax partner at Vijayarachi and Company and Vijayaratna and Company. His expertise extends across diverse sectors where he has provided invaluable insights in tax advisory services. So, Mr. Nadika is an associate member of the Institute of Chartered Accountants of Sri Lanka and holds a special degree in accounting from the University of Sri Jayawardhanapura, demonstrating a commitment to excellence in both theory and practice. And especially in 2010, Mr. Nadika was awarded the prestigious prize for the subject Advanced Taxation and Strategic Tax Planning by the Institute of Chartered Accountants of Sri Lanka, a testament to his exceptional understanding and proficiency in this field. And in addition to his corporate leadership role, Ms. Nadika serves as a visiting lecturer at the Department of Accounting of the University of Sri Jayawardhanapura. I can remember last year also he contributed to the past students, and this year also he has joined with us, which is very valuable to you all. And Mr. Nadika's commitment to the field is evident through his active involvement in various committees of the Institute of Chartered Accountants of Sri Lanka. Notably, he has contributed to the CA Tax Technical Forum, showcasing his dedication to advancing tax expertise with the professional community. And also, as a director of HLB Lanka Business Advisory Services Private Limited, Vijayaratna and Company Taxation Services Private Limited, PASS Consulting Private Limited, and also PASS Staff Placement Private Limited, Mr. Nadika brings strategic leadership to a diverse range of businesses. So Mr. Nadika Suranjana is not just a seasoned professional, he's a dynamic leader, educator, and a contributor to the professional community. So, Nadik sir, we are really happy and privileged to have you with us today for this special guest lecture. And I believe this would be a great opportunity for our students to learn the latest updates and important insights on that from you. Over to you, sir.
Thank you very much. Hope you can all hear me.
Yes, sir.
Right. Good evening to you all. Thank you very much for the warm introduction, Natasha Miss. And it's always an honor to be invited to make this discussion on the value-added tax provisions in the law. So we will quickly move into the presentation because we have about 50 slides to discuss today, because I have incorporated most of the new developments that have taken place recently. Actually, the recent amendments, some of the recent amendments were certified by the speaker last week. So I took those amendments also into our discussion today. So with that, we will quickly move into the presentation. Right. As you are aware, taxes are imposed through legislation. So without an act that is passed in the parliament, even the government cannot charge taxes from the public. So for various taxes, we have various different types of tax. If you take income tax, we have the Inland Revenue Act. If it is SSCL, we have the SSCL Act. If it is value-added tax, so the governing act is the Value-Added Tax Act number 14 of 2002. Right, as you can see, VAT was introduced in 2002 by this act, Value-Added Tax Act number 14 of 2002. So basically, what we are going to do today is we are going to discuss about some of the key provisions that are there in the Value-Added Tax Act. Well, this is going to be my presentation outline today. First, we will discuss about the imposition of VAT, and we will look at some key interpretations and the concept of time of supply and the registration requirements, goods or services supplied in Sri Lanka, and non-taxable supplies. Then we will discuss about VAT on importation of goods. Then the calculation part, how to compute the VAT payable. Then some of the obligations we have under this law once you become a registered person. Then finally, we will discuss about the simplified value-added tax. Right. We'll move into the presentation. If, as you can see, it's 1 minute. Right. Now, we will start with Section 2 of the Value-Added Tax Act, that is known as the charging section of the law, Section 2. So, as per Section 2, VAT is charged in two circumstances, right? So, we will try to have an understanding about Section 2 first. So, VAT shall be discharged in two circumstances, as I told you, under A and B, right? VAT shall be charged at the time of supply on every taxable supply of goods or services made in a taxable period by a registered person in the course of carrying on or carrying out a taxable activity in Sri Lanka. So under this situation, VAT is charged, or VAT should be payable by a registered person. If you want to charge VAT, first you must be a registered person. That alone is not enough. This registered person has to carry on or carry out a taxable activity in Sri Lanka. There has to be a taxable activity in Sri Lanka. That is also not enough. When he's doing this taxable activity, he has to supply taxable supply of goods or services, right? And in that case, if all these conditions are met, VAT is charged at the time of supply, right? You may not understand what this really means, but because there are some words that I have highlighted here, so we need to discuss the meaning of these words to get an understanding of this section, right? For the time being, let's try to get a basic understanding. I will read that again. VAT shall be charged at the time of supply. The time of supply is highlighted. So we will have to discuss about this separately. On every taxable supply of goods and services, this is important, right? If you look at this classification, I think this slide is not in the presentation that I shared. If you look at this classification of supply of goods and services, basically it can be divided into two parts: taxable supply of goods and services and non-taxable supply of goods and services. That is known as exempt supplies. So the supply of goods and services is divided into two: taxable and non-taxable. This taxable supply of goods and services can again be divided into two: supplies chargeable at the standard rate, supplies chargeable at the zero rate, right? The standard rate, zero rate, exempt supplies, and all that we will discuss throughout our presentation. But keep this classification in your mind. You can understand most of the provisions easily if you keep this classification in your mind. Supply of goods and services is of two types: taxable and non-taxable. Taxable part is again divided into two: standard rate supplies, and zero rated supplies. So if you go back to section 2, VAT is charged only on taxable supply of goods and services. It is not charged on non-taxable supply of goods and services. Right. So as I told you, there has to be a taxable activity which is carried on or carried out in Sri Lanka. So we will have to look at the meaning of taxable activity as well. So that is basically the part A of section 2. Now we look at the part B. VAT shall be charged on the importation of goods into Sri Lanka by any person. On the importation of goods, when you import goods into Sri Lanka, VAT is charged. Here, actually, the word registered person is not there. By any person. By any person. You don't have to be a registered person, though actually there's a small registration requirement that you need to satisfy even when you import goods into Sri Lanka. But still, VAT is charged on the importation of goods into Sri Lanka. So under these two circumstances, VAT shall be charged. Right. Now we will focus on the highlighted words that are there in section 2. Then after discussing about the meaning and the inclusions, exclusions, and all that, then you will have a better understanding about this section 2. Right. VAT on taxable supply of goods and services. Now we are focusing on section 2, part A, the first part. The following conditions should prevail for chargeability of VAT under this provision. The taxable activity should be carried on or carried out in Sri Lanka. There should be a taxable activity which is carried on or carried out in Sri Lanka. There should be a taxable supply of goods or services. The person should be a registered person. Right? These conditions should prevail to charge VAT under section 2A, first part. Now we'll look at the meaning of taxable activity. There has to be a taxable activity, as I told you, to charge VAT. So section 83 of the law, that's the interpretation part, interpretation section in the Value Added Tax Act. It defines taxable activity as 5 activities. There are 5 activities that are treated as taxable activity. If a person wants to charge VAT, he has to do one of these 5 activities. Now we'll look at one by one and see what this really means. So the taxable activity means any activity carried on as a business, trade, profession, or vocation, other than in the course of employment or every adventure or concern in the nature of a trade. Basically, if you are doing a business, trade, profession, or vocation, that says you are carrying on a taxable activity. But see, the employment has been excluded. Employment is not treated as a taxable activity. Now, but profession is covered. But you have to understand the difference between these two. Even if you are a professionally qualified individual, if you are employed in an organization, that is your employment, which is not covered under taxable activity. But if you do consultancy services to various organizations as an independent consultant, that is not your employment. That comes under profession, right? If it is profession, that is treated as a taxable activity, right? Then you are doing a taxable activity, there's a taxable activity, so you are chargeable with VAT. Number 2, or the second activity, the provision of facilities to its members or others for a consideration and the payment of subscription in the case of a club, association, or organization. So in a club or association, there are members and the club provides various facilities, and generally the club or the association collect subscription or payments from its members. So that is covered here as a taxable activity. So that's covered here as a taxable activity, or that club or the association is deemed to carry on a taxable activity. So they may be liable to charge VAT because they are doing a taxable activity. The third one, anything done in connection with the commencement or cessation of any activity or provision of facilities referred to in A or B. The commencement or cessation of any activity referred to in A or B. As an example, if you do something in connection with opening up of a business, setting up of incorporating a company, right? That is covered as a taxable activity. Or if you are closing down business, liquidating a business company, that is also covered as a taxable activity. Those are also taxable activities. Next one, the hiring or leasing of any movable property, or the renting or leasing of immovable property, or the administration of any property. So if you own a property and if you lease it out, whether it's movable or immovable, that is treated as a taxable activity. So you are doing a taxable activity. If other requirements are met, that we will discuss in a while, you may be chargeable with value-added tax. So these activities are also treated as taxable activities. The fifth one, the exploitation or the usage of any intangible property, such as patents, copyrights, or other similar assets, where such asset is registered in Sri Lanka or the owner of such asset is domiciled in Sri Lanka. If you are using an intangible asset, and if that particular asset is registered here, or the owner of these intangible assets is domiciled in Sri Lanka, that is also treated as a taxable activity. So these are the 5 activities that are treated as taxable activities under Section 83 of the law. So if you do any of these activities, there is a taxable activity which is chargeable with VAT. Right. Now there is a question on this area. Question number 1. A company which is engaged in the business of manufacture of articles has the following income disclosed for the quarter ended 31st December 2023. Under turnover, they have disclosed sale of manufactured goods locally, 1,200 million. Export of manufactured goods, 500 million. Under other income, they have recorded repair services, 129 million. Scrap sales, 35 million. Rent income, 5 million. Dividend income, 4 million. Interest income on fixed deposits, 2.5 million. Identify whether the said items are chargeable with VAT and state the taxable activity into which the said items fall. Right. Now, if you take the first one, sale of manufactured goods locally, there is a taxable activity. There is a taxable activity. What's the taxable activity? That's the first item or the first activity in the definition for taxable activity. This is basically the business of the company, right? So that is covered. So the sale of manufactured goods locally is chargeable with VAT, and that falls under category A of the definition for taxable activity. Export of manufactured goods, 500 million. So that is also their business. That's also their business. So that is also chargeable with VAT, and that also falls under item A or the category A of the definition for taxable activity, which is business. Other income, repair services, 129 million, and also scrap sales. These are part and parcel of your turnover, the business. So these two items, repair services and also scrap sales, are captured under item A or the category A of the definition for taxable activity, and they are chargeable with VAT. Rent income. So this company is engaged in the business of manufacture of articles. So rent income, leasing out, renting out of their properties and earning rental income may not be their business. But still that is covered under item D, hiring or leasing of any movable property or the renting or leasing of immovable property. So that is covered under item D of the definition for taxable activity. Therefore, that is also chargeable with VAT, and that item falls under item D of the definition. Dividend income and interest income, these are not pure business income, these are investment income. So dividend income and interest income, they are not captured under any of these activities. So therefore, there is no any taxable activity. Therefore, dividend income and interest income are not chargeable with VAT. But these are captured under a separate chapter of the law, which we will discuss next year when you're in the fourth final year. That is covered under VAT on financial services. But what we are discussing here is the normal VAT system. So under normal VAT, dividend income and interest income is not captured because there is no any taxable activity. Right. As I told you, first, there has to be a taxable activity. And when a person does this taxable activity, he has to supply taxable goods and services. Taxable goods and services. So the supply, there should be a supply of goods and services. So these terms are defined in the law. Right. So what is meant by taxable supply? Taxable supply means any supply of goods or services made or deemed to be made in Sri Lanka, which is chargeable with tax under this act, and includes a supply charged at the rate of 0% other than an exempt supply. Can you remember the classification that we discussed here? It says basically the taxable supplies, including zero-rated supplies. So the supplies chargeable at the zero rate are included in the taxable supply, but it does not include non-taxable supplies or exempt supplies. So supply of goods and supply of services. If it is a taxable supply, or whether it is non-taxable supply, it can be a supply of good, it can be a supply of service. The supply of goods and supply of services are also defined in the law. Now we look at the definition for supply of goods. Supply of goods means the passing of exclusive ownership of goods to another as the owner of such goods or under the authority of any written law. If you are the legal owner or if you are given the authority And if you pass the exclusive ownership of a particular good to another person, that is treated as a supply of goods. It's not a complicated definition. You are just basically transferring the ownership of a good. And it includes the sale of goods by public auction, transfer of goods under hire purchase agreement, sale of goods in satisfaction of a debt, and transfer of goods from a taxable activity to a non-taxable activity. The fourth one, transfer of goods from a taxable activity to a non-taxable activity. What does that mean? Now, let's say you are running a business and let's say in your balance sheet, there's an asset. Let's say your trading stock. If you take that trading stock for your personal use, or if you donate your trading stock to a charitable organization, you are transferring goods from a taxable activity to a non-taxable activity. That says there is a supply of goods. There is a supply of goods. You may be liable to pay value-added tax on this. Right. So that's the definition for supply of goods. Supply of services. Supply of services means any supply which is not a supply of goods. Now see how they have structured these definitions. Supplies are of two types. It can be a supply of goods. It can be a supply of service. Supply of goods is defined. There's a particular definition given. Supply of services is defined to include all the supplies that are not captured under supply of goods. So there is no any room to play, right? Everything is covered. What is not covered under supply of goods is covered under supply of services. In addition to that, supply of services includes any loss incurred in a taxable activity for which an indemnity is due. This is important. Right. If you incur any loss in a taxable activity, now when you are running your business, let's say your trading stock is damaged due to a flood, right? So you are incurring a loss. But if you have insured your trading stock, the insurance company will indemnify your loss. Your loss is indemnified or compensated, right? In that case, the law says supply of services includes any loss incurred in a taxable activity for which an indemnity is due, right? So that is also captured as a supply of service, right? Therefore, even your insurance claims are subject to value-added tax. Right. Now we look at question number 2. Advise whether the following supplies fall within the meaning of taxable supplies for the purpose of chargeability of VAT. Supply of manufactured goods, which is chargeable at the standard rate of 18%. As you all know, the current VAT rate is 18% with effect from 1st January 2024. So supply of manufactured goods, which is chargeable at the standard rate of 18%, whether it is a taxable supply or not, it is a taxable supply. So taxable supply of goods and services is divided into two. Supplies that are chargeable at the standard rate, supplies that are chargeable at the zero rate. Export of manufactured goods, which is chargeable at 0%. So if you can remember that classification, This is also captured under taxable supply. Third one, supply of electricity, which is an exempt supply under the first schedule to the VAT. Exempt supplies or non-taxable supplies are not treated as taxable supplies. So the third one is not a taxable supply. The first two are chargeable with VAT because they are treated as taxable supplies. Now we look at question number 3, that is on supply of goods and supply of services. Advise whether the following transactions fall within the scope of VAT as a supply of goods or a supply of service for a VAT registered company. Sale of manufactured goods. Here what happens is, you as the owner of these manufactured goods, you transfer the ownership of these goods to your customers. So that is captured under supply of goods. Export of manufactured goods. Supply of goods. You are transferring the exclusive ownership of the goods. Disposal of machinery. It could be a property, plant and equipment. It could be your trading stock, whatever it is. If you are transferring the ownership of that particular good, it falls under supply of goods. Donation of manufactured goods to the government. Donation of manufactured goods to the government. What happens is, you are transferring goods from a taxable activity to a non-taxable activity. That is captured under supply of goods. Renting of part of business premises. Renting of part of business premises. Is it a supply of good? Are you transferring the exclusive ownership of the building to the tenant? No. Then that is covered under supply of service. It's a supply of service. Insurance claim received in respect of damaged goods or damaged stocks manufactured by the company. As I told you, if there is any loss incurred in a taxable activity, and if that loss is indemnified, it is treated as a supply of service. So the last one falls under supply of service. Right. Another important concept in section 2, taxable period. The word taxable period was there in section 2. So now we will look at the meaning of this taxable period. What does that mean? Basically, taxable period could be a 1-month period, or it could be a 3-month period. For some registered persons, 1-month period is applicable, and for others, the 3-month period is applicable. Now we will see who are the persons who can apply 1 month and 3 months period. So taxable period means a period of 1 month where any person registered with the simplified value-added tax scheme and accorded registered identified purchaser status. So this simplified value-added tax scheme and the RIP status we will discuss in the latter part of our presentation. So basically, if you are exporting goods, as an example, if you are exporting goods, you are eligible to register as a RIP under the Swat scheme. And if you are registered as a RIP, then the applicable taxable period to you is 1 month period, right? So this simplified value-added tax and all that we will discuss at the end of this presentation. Second one, where any person has commenced a business or started a project and undertakes to comply with the requirements of Section 22(7) of the Value-Added Tax Act. Now, these are long-term projects. Basically, as an example, if you take a hotel project, to make supplies, to provide accommodation, to provide meals and all that. So it takes a considerable time. So before you make your supplies, you need to first buy land and construct your hotel, purchase so many equipment. It takes a considerable time to make taxable supplies, right? So there's a project implementation period. So they don't have to wait till they make taxable supplies to register. There's a special section in the Value-Added Tax Act, which is Section 22(7). So you can go and register under this Section 22(7). Once you register under Section 22(7), the applicable taxable period is 1 month period, right? So Section 22(7), where any person has proved that such person has commenced any business or any project in Sri Lanka and undertakes to make taxable supplies in respect of such business or project within a period of 30 months, from the commencement of such operation, then he may register such person subject to such condition as may be specified by him, right? These are long-term projects. Initially, you will be allowed 30 months period for the project implementation. Then after that, you need to make taxable supplies. Right. Here you need to, what you need to keep in mind is that once you register under Section 22(7), you are falling under 1 month taxable period. And we have another taxable period, which is 3 months period. 3 months period is applicable to all the other registered persons who are not covered under 1 month taxable period, right? But still, if you are covered under 1 month period, and still if you want to come under 3 months period, that is also allowed. A period of 3 months commencing respectively on the 1st day of January, the 1st day of April, 1st day of July, and the 1st day of October of each year in respect of a registered person. Other than A above, and O, who opts to submit quarterly returns on the approval by the Commissioner General, right? Even if you are covered under 1 month period, if you still want to come under 3 months period with the approval of the Commissioner General, you can change it. You can come under 3 months period. So these are the 2 taxable periods. We have 1 month and 3 months period, right? If you can remember Section 2, when it starts, it says, what shall be charged at the time of supply? One of the most important concepts in the value-added tax law, right? One of the most important sections, I would say, in the value-added tax law. Now, this is very, very important. You would have seen some of the companies at promoting their products before 31st December 2023. Come and buy our products before 31st December and enjoy 18% off, right? That is under this section. So very, very important section, because this can be used to plan our tax exposure, especially when there are changes in the VAT law. As you may be aware, we will discuss all this in a while. The VAT threshold was 80 million earlier, it was reduced to 60 million. Most of the exemptions that were there up to 31st December have been removed, right? Some of the industries, even if you take motor vehicle, earlier it was exempt, now it is liable. So solar panel, especially solar panels, earlier it was exempt, now they are liable. So they could have used, actually they have used this section to plan their tax exposure. So therefore, this is very, very important concept in the Value Added Tax Act, right? Time of supply. It says the time VAT shall be charged at the time of supply, right? The time of supply is the time at which VAT is chargeable, right? In a particular transaction, what is the time VAT is charged, right? This has been defined or explained in the law in relation to 4 circumstances. We'll take one by one. Now, if you look at here, 3.1, time of supply in relation to supply of goods. When you supply goods, what is the time of supply? Under 3.3, 3.2, time of supply in relation to supply of services. 3.3, time of supply in relation to a supply made under an agreement providing for periodical payments. So supply as per an agreement which provides for periodical payments will be made periodically in installments. In that case, what's the time of supply? At what time that shall be charged? And also under 3.4, supply on payment basis as directed by the CGIR. That's a special situation where you need to get the prior approval. Now we will take one by one and see what is the concept of time of supply. At what point the VAT shall be charged? If it is supply of goods, the supply of goods shall be deemed to have taken place at the time of the occurrence of one of the following, whichever occurs earlier. The Act has given 4 incidents or 4 circumstances that can happen in a particular transaction. Since this is coming under supply of goods, when you supply goods, the Act has given 4 incidents that can happen in a particular transaction, right? And the Act says you have to identify the time of the occurrence of any of the following, whichever occurs first. The activity that happens first decides the time of supply. Now, what are the activities? The issue of an invoice by the supplier in respect of the goods. That is basically the date of the invoice, the time of issuing the invoice, right? Or the payment for the goods, including any advance payment received by the supplier. That's the time of receipt of money. It could be an advance payment. Third one, a payment for the goods is due to the supplier in respect of such supply. That's when the receivable is recognized. And the fourth one is the delivery of the goods have been effected. That's the time of delivery of the goods. So in a particular transaction of supply of goods, identify these 4 activities and take the first activity. That is the time of supply. If you issue the invoice first, before you collect money or before you deliver the goods, the date of the invoice should be the time of supply. If you deliver the goods without issuing an invoice or without collecting cash, the date of delivery is the time of supply, right? So the activity that happens first decides the time of supply. Having said that, if you issue the invoice within 10 days after delivery of the goods, though you issue the invoice later, you need to take the date of the invoice as the time of supply, right? This is an exception. If you issue the invoice within 10 days after you deliver the goods, the date of the invoice should be taken as the time of supply. right? Notwithstanding the above, where an invoice is issued in respect of goods delivered within 10 days from the date of delivery of such goods, the time of supply of such goods shall be deemed to be the time at which the invoice was issued. Even though you issue the invoice later after delivery of the goods, you still need to take the date of the invoice if you issue the invoice within 10 days, right? So how we can use this section or this concept in planning your tax exposure? What did these solar companies do? Earlier, solar panels and modules, they were exempt from value-added tax. We'll discuss about exempt supplies in a while, right? So they were exempt from VAT. They knew that the government was going to charge 18% VAT after 1st January 2024. So they were promoting and they were requesting their purchases, their customers to come and purchase their solar panels before 31st December and enjoy an 18% reduction. That comes under this concept, time of supply. If you go and at least make an advance payment before 31st December, on that advance payment, the company is not liable to charge VAT. Right? Hope you understand. If it is after 1st of January, they have to charge 18% VAT on that, right? And gold, it was exempt earlier. So after 1st of January, this supply of gold was made liable. So the prices were supposed to go up by 18%, right? So these concepts we can use officially, legally. These are concepts in the law to plan our tax exposure, right? Even for our marketing campaigns, we can use these, especially when there are changes in the VAT law, right? Now we will look at, well, that is about the time of supply in relation to supply of goods. Now we look at the time of supply in relation to supply of services. Right. Here also the same, everything is the same. Only difference is there is no supply of goods. Here what we have is supply of services. The supply of services shall be deemed to have taken place at the time of the occurrence of any of the following, whichever occurs earlier. Out of these four incidents, you have to identify the activity that has happened first. The service was performed, the payment is received, the payment is due, or an invoice is issued. The time of performing the service, the time of collecting cash, including advance, whether the payment is due, or whether it's the date of the invoice, right? Identify the activity that happens first in a particular transaction of supply of services. That's the time of supply. But this 10 days rule is still there. If you issue an invoice within 10 days after performing the service, even though you issue the invoice later, still you need to take the date of the invoice as the time of supply. That is an exception. Notwithstanding above, where an invoice is issued in respect of services supplied within 10 days from the date of performance of such service, the time of supply of such service shall be deemed to be the time at which the invoice was issued. The date of the invoice should be taken as the time of supply if it is issued within 10 days. Right. Third one, time of supply in relation to a supply made under an agreement providing for periodical payments. So here what happens is you do a supply under an agreement and the payment will be made periodically in installments. So it has been divided into two. If it is under hire purchase agreement, I mean, if it is any other agreement other than a hire purchase agreement, right? If it is a hire purchase agreement, where goods are supplied under hire purchase agreement, the supply shall be deemed to have taken place at the time the agreement is entered into. So at the time the agreement is signed, VAT is chargeable or VAT is payable, right? Even though the payments are made in installments, right? If it is a hire purchase agreement. If it is an agreement other than hire purchase agreement, the supply shall be deemed to have taken place when the payment is due or when the payment is received, whichever is earlier, right? Not when the agreement is signed. If it is a hire purchase agreement, it's the time the agreement is entered into. If it is any other agreement, the time of supply is when the payment is received or when the payment is due, whichever occurs earlier. Right. Next one, supply on payment basis as directed by the Commissioner General of Income Revenue. Now you know the concept of time of supply in relation to supply of goods, supply of services. Now, as an example, we can take supply of goods. You are liable to pay value-added tax even though you have not collected money. Now, let's say you deliver the goods today, you issue the invoice today, and you will receive the consideration in 6 months' time, right? So you can't wait for 6 months to pay VAT. Under this concept, time of supply, you are liable to pay value-added tax today, right? So once we apply this concept of time of supply, this may affect some of the businesses in a negative way, especially when their income is not received instantly. I mean, when it takes a considerable period to receive their payments, so this concept is going to affect them badly. Now, as an example, I can take construction business. Once you complete your construction, you have to issue your invoice that may be subject to various adjustments, and it will take a considerable period to receive the payment. And if you are doing these projects to government organization, the situation is worse. It will take a considerable period. Now, if you apply this time of supply concept and ask these construction companies to pay value-added tax, so they are not going to, I mean, that will affect very badly on the operations. They may not be able to continue their operations. You know, in constructions business, though the amounts or the values are high, the margins are lower. Now we are asking for 18%, right? Even without collecting cash, you apply time of supply and pay 18% now. That's not going to happen, right? They won't be able to run their operations. So there is a special scheme introduced under the Act. If you are badly affected by the application of this time of supply concept, you can get the prior approval of the Commissioner General to apply the cash basis, right? Without approval, you are not entitled. You cannot apply this cash basis of accounting. So if you are allowed to apply this method, time of supply is the time of receipt of cash. If you get the approval under section that is given in section 23 to apply the cash basis, if you get the cash basis approval, you can wait till you collect the money. Once you collect the money, then you are liable to pay it to the government, right? So supply on payment basis as directed by the Commissioner General of Inland Revenue, where the Commissioner General directs any registered person to account for the tax on a payment basis under section 23. The time of supply of goods and services supplied by such person shall be the time at which the payment in respect of such supply is received. Time of supply is the time of receipt of money. Right. Now we look at question number 4 to understand this time of supply concept. Identify the time of supply in relation to the following circumstances. Goods were delivered on 20th December 2023 and the invoice was issued on 7th January 2024. Goods have been delivered on 20th, invoice has been issued on 7th January, right? So the invoice has been issued later, right? Has the company issued the invoice within 10 days after delivery of the goods? No. Then you cannot take the date of the invoice as the time of supply. You have to take the date of delivery, which is 20th December 2023 as the time of supply. Next one. Goods were delivered on 20th December 2023 and the invoice was issued on 27th December 2023. Now here see, the invoice has been issued within 10 days after delivery of the goods. Then in that case, though you have delivered the goods before you issue the invoice, since you have issued the invoice within 10 days after delivery of the goods, you have to take the date of the invoice as the time of supply. So in that case, it is 27th December 2023. That's the time of supply. Next one, invoice was issued on 27th December 2023 and the goods were delivered on 30th December 2023. Goods have been delivered within 10 days after issuing the invoice. Can we apply the 10 days rule here and say the date of delivery of goods is the time of supply? No. That is not applicable here. If you issue the invoice first, you have to take the date of the invoice as the time of supply. Right? This 10 days rule is applicable where you deliver the goods first and issue the invoice within 10 days. Then in that case, you can take the date of the invoice. But here what has happened is, you have issued the invoice on 27 December and after that you have delivered the goods. So you have to take the date of the invoice 27 December 2023 as the time of supply. Right. Still we are discussing about section 2A. Now we are discussing about the highlight about the keywords that I have highlighted in section 2, right? As I told you, you have to be a registered person. First of all, you have to be a registered person to charge VAT. Right? This is a special authority the government gives to you to collect taxes on behalf of the government from the public. Right? So this is a special authority. Therefore, first you must be a registered person. Then the government can control you. Government can see what you are doing, and they have they can see what you are doing. Right? They have the control. So first you need to be a registered person if you want to charge value-added tax. Right? Now we look at the registrations requirements. Any person registered by CGIR in the following manner shall be a registered person. Right? The Commissioner General shall register a person for VAT where an application has been made by any person for registration under Section 10. So the registration requirements are given in Section 10. So if you satisfy the conditions to be a registered person, you must go and register. Right? You have to make an application and register under Section 10. That is called mandatory registration. You are liable to register. Right? Now, let's say you are liable to register. You know that you are liable to register, but you just keep quiet. Right? You just don't go and register. What will happen is if the Commissioner General or the Inland Revenue finds out that there is a liable person who has not made an application, what will happen is you will be taken there and you will be forced to register. You will be registered. That is called forced registration. It could be a mandatory registration. It could be a forced registration. Whatever the manner in which you are registered, once you become a registered person only, you can charge value-added tax. Now we will look at Section 10 and try to understand the registration requirements that are applicable now. Requirement for the registration that is given in Section 10. So, right, first we will look at Section 10 and then I'll explain. Every person who carries on or carries out a taxable activity in Sri Lanka shall register with effect from 1st January 2024 for VAT if, right, there should be a taxable activity in Sri Lanka. So they are liable to register after 1st January 2024. These are the new requirements effective from 1st January 2024. If. So this registration can happen based on two situations. I mean, in two circumstances that can be done. So you can take your historical data and apply for the registration. Or you can estimate your future data and apply for the registration, right? Under A, if total value of taxable supplies, remember the classification. You have to take the value of taxable supplies, whether it is zero rated or not. If it is, you have to exclude non-taxable supplies or exempt supplies. You have to take only the value of taxable supplies. Supplies which are chargeable at the standard rate and the supplies that are chargeable at the zero rate. You have to take the total of these two. Made in a taxable period. It could be a 1 month period, it could be a 3 months period. And see whether you have exceeded 15 million at the end of the taxable period. After the taxable period, you take your historical data and you take the value of the taxable supplies you have made during that taxable period and see whether you exceeded 15 million or not. If you exceeded 15 million, you must go and register. Or the total value of taxable supplies has exceeded ₹60 million in any 12 months period, right? If it is a taxable period, you have to exceed 15 million. The value of the taxable supplies should exceed 15 million. If it is a 12 months period, the value of taxable supplies should exceed 60 million, right? So this is basically based on your historical data. Now the second part. If you have reasonable grounds to believe that you will exceed this threshold. You will exceed 15 million in the coming taxable period. You will exceed 60 million you will exceed 60 million in the next 12 months period. Then based on that also, you can apply for the registration. Now, as an example, you have just set up a company and you have received a purchase order from your one of your customers to supply, let's say 100 million worth of goods during the next 12 months period, right? That's a confirmed order, right? Then you know that you will definitely exceed this threshold in the next 12 months period, right? So then you don't have to wait till wait for 12 months to apply for the registration. You have to go there and explain that I'm going to exceed this threshold, so I need to get the registration, right? So this can be done based on the historical data and also based on the estimated data, right? So if you exceed these thresholds, you must go and register. That's called the compulsory registration, mandatory registration. And if you exceed these thresholds and if you still do not register, you will be forced to register. You will be taken and you will be registered there, right? That is called known as forced registration. You are forced to register. There's another registration called voluntary registration. You are not liable to register. Now, let's say the value of taxable supplies in the taxable period is less than 15 million. Then you are not liable to register, right? But still, if you want to register, right, you want to register and pay taxes, collect taxes on behalf of the government, and pay taxes to the government, right? You are not liable to register, but you are entitled to register, right? So that is called voluntary registration. So under this, you can make an application to register under this scheme, but this may be rejected by the Commissioner General of Inland Revenue because as per the law, you are not liable to register. Therefore, this may be rejected, but as per the law, you are entitled to register for value-added tax because why this is rejected? Because as I told you, this is a special authority that is given to you by the government to collect taxes on behalf of the government from the public, right? So it's special authority. So therefore, considering the facts of the case, the department may register or may not register. That depends, right? But still, you are entitled to apply for the registration. That is called voluntary registration. Section number 5. Determine whether the following persons are required to be registered under the VAT Act. Now see whether they have exceeded the threshold or they will exceed the threshold. An individual who provides consultancy services with an annual income of 55 million. The annual income is 55 million. Therefore, it is below the annual threshold that is given. If it is 12 months period, then the value of taxable supply should be 60 million or more. So in this case, it is less than that. So therefore, they are not, that individual is not required to register under the VAT Act. Second one, a company which is engaged in the sale of locally purchased goods with an annual turnover of rupees 75 million. They have exceeded the threshold, annual threshold, 60 million they have exceeded. Therefore, this company is required to register under the Value-Added Tax Act. Third one, a company which is engaged in the sale of manufactured goods with a turnover of 18 million For the quarter ended 31st March 2024, though the year is not over, I wanted to include the new provisions, 31st March. We are still the 29th March, 2 more days to go. Anyway, from 1st January 2024 to 31st March 2024, their turnover is 18 million. Right? The value of taxable supplies is 18 million. However, its estimated revenue from confirmed orders would not exceed 60 million by 31st December 2024. During the first taxable period, they have exceeded the threshold. They exceeded 15 million. But we have 3 more taxable periods to go. If we take estimated revenue from confirmed orders, there is no reasonable grounds to believe that we will exceed 60 million by the end of this year. Are you liable to register? Is this company liable to register? Yes, because they've exceeded the threshold given in a particular taxable period. Once you exceed, you don't have to wait for another 12 months period to say whether you will exceed the annual threshold or not, right? Immediately you must go and register the moment you exceed the threshold for a particular taxable period. So this person or this company is required to register under the VAT law. Right. This is also an important concept in the Value-Added Tax Act. As I told you, the taxable activity, there should be a taxable activity which should be carried on or carried out in Sri Lanka. If the taxable activity is carried out or carried on outside Sri Lanka, that is not covered within the scope of VAT. If you are doing offshore businesses, it's not covered, right? And when you are doing this taxable activity, you have to supply, or your supply should be taxable supply of goods or services. Now, as an example, you are running a business. You are running, let's say, a pharmacy, right? You are buying and selling drugs, pharmaceutical items. Pharmaceutical items are exempt from VAT. We'll discuss the list in a while. The pharmaceutical items are exempt from VAT. So you are doing, there is a taxable activity, which is your business, right? You are not supplying taxable goods, right? So in that case, VAT is not chargeable, right? So there should be a taxable activity in Sri Lanka, and you must supply goods that are chargeable, or you must supply taxable services. Goods or services shall be deemed to be supplied in Sri Lanka, where the supplier carries on or carries out a taxable activity in Sri Lanka, and the goods are in Sri Lanka at the time of supply, or the services are performed in Sri Lanka by the supplier or his agent. So these conditions should prevail to charge value-added tax. Now let's look at question number 6. Advise whether a company engaged in the business of providing management consultancy services is chargeable with VAT on the following transactions. Services rendered in Sri Lanka to clients in Sri Lanka. Services rendered in Sri Lanka to clients in Sri Lanka. The taxable activity is carried on or carried out in Sri Lanka. So this is chargeable with VAT. Next one, services rendered in Sri Lanka to clients outside Sri Lanka. Your client could be a person in Sri Lanka, it could be a person outside Sri Lanka, doesn't matter. The place where the service is provided is the key factor here. Where have you rendered your services? Services rendered in Sri Lanka, it is chargeable with VAT. Because that is captured under section 2. The taxable activity is carried on in Sri Lanka. Third one, services rendered outside Sri Lanka to clients outside Sri Lanka. So this is not covered. So this particular transaction is not chargeable with VAT. It is outside the scope of VAT. Because the services have been rendered outside Sri Lanka. Hope that is clear. Right. Now we will look at the non-taxable supplies. So as we have been discussing, VAT is not charged on non-taxable supplies or exempt supplies. VAT is charged only on the taxable supply of goods or services. So what are these exempt supplies or non-taxable supplies? Right. A registered person is chargeable with VAT only in relation to taxable supplies that we already know. Exempt supplies listed in the first schedule to the Act are not subject to VAT. So all these exempt items are listed in the first schedule to the Value Added Tax Act. Right. Now we had a lengthy list of about 400 hundreds of exemptions. So earlier, actually, I did not even look at the exempt list when I was doing this lecture earlier. I just shared the exempt list and I asked the student to read and understand, because we didn't have a time, because it was so lengthy, so many exemptions, right? As I told you, this was VAT was introduced in 2002, right? Now we are in 2024. So many amendments, so many corrections, removals, exclusions. It was utterly a confusion, right? Now the government has understood the complications we have, so they have simplified this, right? They have removed most of the exemptions and they have given about 40 plus exemptions now, right? Now you look at, I have now included and all the supplies that are exempt from value-added tax, but still I don't think that we'll have time to go through one by one, but still we can, at least we can read some of these. Now before that, these exempt items have been grouped under the first schedule under different headings, right? So before you read the first schedule, first you must understand, or first you must identify the group under which those are listed. Now these exemptions that are provided in the first schedule under the following categories. There are 4 categories, as you can see. Supply or import. If any supply is listed under supply or import category, what does that mean? When you import that particular item, it is exempt from VAT. And also when you supply that particular item, that is also exempt from VAT. Importation is also exempt, supply is also exempt. Right? The second category is supply. If any item is listed under this category, supply category, the exemption is applicable only when it is supplied. If that particular item is imported, that exemption is not applicable, right? So first look at the heading under which it is listed. Third category is import. The items listed here are exempt only when they are imported. If they are supplied locally, exemption is not applicable, right? The fourth category is import and supply. You have to import and supply, then the exemption is applicable. Now we will quickly look some of the exemptions. Actually, I have given all the exemptions that are applicable at the moment, but we'll discuss only few exemptions under these four headings. Now, the first heading is import or supply. Importation is exempt, supply is also exempt, right? So what are the items that are listed here? Wheat or wheat flour, infant milk powder, pharmaceutical products, drugs, as I told you, when you run a pharmacy, these pharmaceutical products are exempt from value-added tax. Ayurvedic preparations, crude petroleum oil, kerosene, aviation fuel, oil for ships or fuel oil, artificial limb, crutches, wheelchairs, hearing aids, white canes, braille typewriters and parts, braille writing papers, braille writing boards, basically some items that are used by disabled persons. But interestingly, there was, you may have seen some of specific motor vehicles that are used by disabled persons. It was exempt earlier, but it has been removed. So these special motor vehicles are now liable to VAT. So biofertilizer, artemia eggs and peat moss. So see, only biofertilizer is there. The importation is exempt, supply is exempt, but chemical fertilizer is not there. Agricultural seeds, agricultural plants, shrimp feed, prawn feed, animal feed, yarn used for textile industry, dyes used for handloom industry. Right, that's the end of category A, which is import or supply. Now the second category, supply of these, mostly the services are listed here, but if any good is listed under this, it is exempt only when it is supplied. If that is imported, this particular exemption is not applicable, right? So therefore, if you are searching for a exemption in the Value Added Tax Act, first look at the heading under which it is listed. So the second one is supply of. Fortunately, they have not removed this exemption, educational services. Public passenger transport services, but other than air transport, water transport, or transport of tourists, excursion tours and taxi services, they are liable. The exemption is applicable only for public passenger transport services. Electricity, fortunately, the exemption is still there, including distribution is still exempt. Services in relation to burials and cremations by any institution or person, right? Now, I think you all have open tax files now. Huh? Since you are over 18, you must have a tax file now. I mean, TIN number, right? So now after, graduation and after you start working, the moment you start getting over 100,000 a month, you will start paying taxes, right? In addition to the taxes that you are already paying in indirect taxes like VAT, SSCL, and all that. But still, you can close your eyes at the end, right? Because our funeral expenses are not going to be VAT liable. Right? This exemption is still there. Services at a restaurant beyond situated beyond the immigration counter at the Bandar Naik International Airport. Only Bandar Naik International Airport is there. We don't know why the other airports are not there. Goods and services to the mission of any state or any organization to which the provisions of the Diplomatic Privilege Act applies. So especially when you supply goods or services to an embassy, foreign embassy, that is exempt from value-added tax. Goods or services funded directly by foreign organization for the relief of sudden distress caused by natural or human disasters, right? So these are exempt from value-added tax. Financial services are not liable to VAT, that is, those are exempt. But actually, now we are discussing about normal VAT. The financial services are captured in a separate chapter. As I told you, we will discuss about that in the final year under VAT on financial services, but that is not covered here. So from normal VAT, it is exempt. That's why when you pay loan installments, you don't pay value-added tax, right? All healthcare services other than hospital room charges. If you admit in a private hospital, all the facilities, the drugs, and even the doctor's fee, everything is VAT-free other than hospital room charges. So there will be a VAT component included on the room charges because the exemption is not applicable on the hospital room charges. Any article imported subject to special commodity levy under the Special Commodity Levy Act number 48 of 2007, subject to the condition that such articles are sold without any processing except adoption for sale. Now, there are some items that are subject to special commodity levy. You would have noticed that they have reduced the special commodity levy rate of rice and onions recently to make available enough stocks in the market for the new year, right? So if basically rice is there, dal, dry fish, onions, those are subject to special commodity levy when they are imported. If any good is subject to special commodity levy at the time of importation, they are not subject to VAT when they are supplied. But you can't do major alterations to the product except at adoption for sale. Right? If you import dal and prepare something else and sell, the exemption is not applicable. Right? So if any item is subject to special commodity levy at the time of importation, when they are supplied locally, they are not subject to value-added tax. Locally manufactured handloom textiles, rice flour, and bread, as so far as such products are manufactured locally. Unprocessed agricultural, horticultural, or fishing products produced in Sri Lanka, as long as they are unprocessed, they are exempt from value-added tax. Locally manufactured surgical gauze used for surgery, fabric which are used, which are subject to a cess at a specific rates. These are some of the specific exemptions given. Services by the Department of Commerce, the Board of Investment of Sri Lanka, or the Sri Lanka Ports Authority when they are provided to exporters. And services by any person in Sri Lanka, this is important. Services by a person in Sri Lanka to another person outside Sri Lanka, to be consumed or utilized by such person outside Sri Lanka, for which the payment is made in Sri Lankan rupees. So you provide your service, and that particular service is consumed by a person outside Sri Lanka. It is utilized outside Sri Lanka, and you receive the payment not in foreign currency, but in Sri Lankan rupees. You are exempt from value-added tax. A similar concept we can discuss under zero-rated supplies also. That's why I highlighted this. If you are paid in rupees, the supply is VAT exempt. Services which result in the improvement of quality, character, or value of any yarn, fabric, or garments. Geriatric services and childcare services. Homes for elders persons. And daycare services, those are exempt from VAT. Goods or services to any project identified as a strategic development project, and goods or services to any specified project, goods or services to any infrastructure development project funded through foreign loans or donation. Some specific exemptions. We are still under the second category, supply of goods or services by the Central Bank of Sri Lanka. It is not liable to pay value-added tax. Any services by any public corporation provided free of charge out of the funds voted by Parliament. So that is exempt from VAT. And locally manufactured goods to duty-free shops for payments in foreign currency. If you manufacture goods and supply it to duty-free shops, and if you are paid in foreign currency, you are not liable to pay value-added tax. So that's the end of the second category, supply of. So if any of these items are imported, they are subject to VAT because they are listed only under supply of category. Now we look at the third category, that is the import of. So items listed here are exempt at the time of importation, but if these items are supplied locally, they are subject to value-added tax. Right. Import of any article entitled to duty-free clearance under the personal baggage. Second one, goods to be used as exhibition material or materials in any technical demonstration and which are re-exported after the completion of such project, exhibition or demonstration, as the case may be. Sometimes you import certain equipments or machineries for technical demonstration or exhibition purposes. So after that exhibition or demonstration, if they are re-exported, at the time of importation, you are not liable to pay value-added tax. And also plant and machinery or equipment which are imported to be used in projects and re-exported after the completion of the project. Sometimes there may be projects for which we need specific machineries, which we don't have in Sri Lanka. So we need to import machineries to do this job here. And once the job is done, we are not going to keep it here. We will re-export that. So if we are re-exporting that after the completion of the project, when they are imported, they are exempt from VAT. Aircraft engines or aircraft spare parts. Chemical naphtha by the Ceylon Petroleum Corporation to be supplied to the Ceylon Electricity Board for the generation of electricity. The import exempt from importation. Goods for any specified project identified by the minister. Goods for a project identified as a strategic development project. And goods for any infrastructure development project funded through foreign loans or donations. goods to a mission of any state or any organization to which the provisions of the Diplomatic Privileges Act applies. If you can remember, the same items were there under supply of category as well, right? So basically, though they have listed under two headings, they are exempt at the time of importation as well as at the time of supply. Goods from any foreign organization or out of the funds from such organization for the relief of sudden distress caused by natural or human disasters. Right. That's the part 3, import of. The fourth category, import and supply. So the items listed here should be imported and supplied. The import and supply of goods at duty-free shops for payments in foreign currency. We found a similar provision under supply. If we go back and see the last one, locally manufactured goods to duty-free shops for payments in foreign currency. Here, what you supply is the goods that are manufactured locally. Here, this particular item is imported into Sri Lanka and supplied at duty-free shops for payments in foreign currency. In both circumstances, the VAT is exempt. VAT is not charged on these supplies. Right. So these are the items that are treated as exempt supplies, so non-taxable supplies. On these supplies, VAT is not charged. Right. Now only we have completed, if you can remember, section 2, part A. Section 2, part A. Now we will look at section 2, part B. VAT shall be charged at the time of importation of the goods into Sri Lanka by any person. Right. So VAT on importation of goods shall be charged, levied, and collected as if it is a custom duty. Registration. So under section 2, it says you need not to be a registered person to charge VAT when you import goods into Sri Lanka. But actually, though that is not the registration that we discuss under section 10, there's a small registration that you need to do here also. That is called temporary registration. Now we discuss about mandatory registration, forced registration, voluntary registration. Now we have temporary registration. That is only to import goods into Sri Lanka, right? Once you import goods into Sri Lanka, before you clear the goods that you have imported, you need to inform the Commissioner General that you have imported goods into Sri Lanka, and you need the registration number to clear the goods, right? Every person who is an importer of goods into Sri Lanka shall notify the Commissioner General not later than 14 days prior to the clearing of such goods that he has imported such goods and obtained from the Commissioner General an identification number for the clearing of such goods. The said notification is not required in the following circumstances. Importation under the personal baggage. Right. You don't have to get a identification number to though basically you are bringing in goods into Sri Lanka in your personal baggage, you don't have to charge VAT. And if you are already registered under VAT under section 10, based on the volume of your supplies, taxable supplies, if you are registered under section 10, you don't have to get another registration or another identification number to import goods into Sri Lanka. Right. Now we will discuss about the VAT payable. So as how to compute the amount of VAT a registered person should pay. Right. It's a simple computation. First, you have to compute the output VAT and you have to compute the input. Take the difference. The difference is the amount you need to pay to the government of Sri Lanka or the Inland Revenue Department. The amount of VAT payable is computed as follows. Output VAT. How to compute the output VAT? Take the value of supply. Value of supply and apply the tax rate. And you get the output VAT. From that, you deduct allowable input VAT. Allowable input VAT. And the difference is the amount you need to pay to the Department of Inland Revenue. If you look at this formula, you take your output, you deduct your input. What is the difference between these two? It is, if you take the difference between output and input, the difference is the value addition, the amount you have added, right? So this is a tax on the value that you have added. That is why it is called value added tax, right? Right. Now we will look at the output VAT. Output VAT is computed by applying relevant tax VAT rates on the value of supply of goods or services. Now we have to discuss about the value of supply and the VAT rates. Right. What's the so-called value of supply? I have given here only the basic rule applicable to value of supply. There are some special situations where we need to. There are special provisions in the VAT law when it comes to sale of lands, lottery business. So value of supply is separately given in relation to those specific circumstances, but I'm not going to discuss all that with you today. I have just taken the basic rule, which is applicable in general circumstances. Right. What is the value of supply? If the supply is for a consideration in money, so general supply, when you supply goods or services, you sell it to your customers and you collect money. If the supply is for consideration in money, the value of supply is the consideration minus the amount you get minus VAT or open market value, whichever is higher. Consideration minus VAT or open market value, take the higher value. So generally, consideration minus VAT and the open market value should be the same. Right. But there may be situations where goods and services are supplied at a price lesser than the market value, especially when it comes to intercompany transactions. When it comes to intercompany transactions, transactions may not happen at the arm's length price, or at open market price. But for VAT purposes, the value of supply, you have to take the market value or the consideration minus VAT. You have to take the higher value out of these two amounts, right? Sometimes if you do your transactions at a price lesser than the market value, you will have to pay, or if the department finds out, or the department doesn't need to find out, actually under the law, you are liable to pay VAT on the open market value, because that says you have to take the higher value. And this concept provides an answer to a question most of the companies or most of the business persons have. Now, think about the situation where I don't know whether you have learned about SSCL, but I think you all are aware that there's a tax called SSCL, and that can be passed on to the customer. Right. Now, assume a situation where SSCL is added to the market price or the selling price and passed on to the customer. Now we have a problem whether we need to charge VAT on SSCL as well. Now let's say the selling price is 100. SSCL, let's say 2 rupees and 50 cents. When we compute VAT, is it 18% on 100 or 18% on 102.5 rupees, including SSCL? Whether we need to apply, whether we need to pay VAT on SSCL as well. Here, the answer is given. What's the answer? You have to take the consideration minus VAT or the open market value, the higher amount. From the consideration, you are allowed to deduct only the VAT component. So all the taxes and everything that you are going to charge from the customer is liable to value-added tax. So basically, if you are collecting SSCL on your supplies, you have to charge VAT on SSCL as well under this value of supply concept. Hope that is clear. Right. If the supply is not for a consideration in money or partly in money, you have to take the open market value. Right. Now you know the value of supply. Now we are discussing about the computation of output VAT. Output VAT is computed by applying relevant rates on the value of supply. Now you know the value of supply. Now we need to look at the applicable VAT rates. Basically, we have two VAT rates. The following rates are applicable on the value of taxable supplies of goods or services. Zero rate, that you already know, and the standard rate. That's why we classified the value of taxable supplies into two, as supplies that are chargeable at the standard rate and the supplies that are chargeable at the zero rate. Right. So we have two rates, zero rate and the standard rate. Zero rate is always zero. Standard rate, the government has the right to change. As you can see, how consistent our tax system is. You can see 18% with effect from 1st January 2024. And the current applicable VAT standard rate is 18%. Before that, 15% with effect from 1st September 2022 to 31st December 2023. Before that, 12% from 1st June 2022 to 31st August 2022. June, July, August. Only 3 months. Right? After that, it was increased to 15%. Before that, when the government did not want taxes from the public, when all the thresholds were increased, rates were reduced, it was 8% before 31st May 2022. Right. Now, these are the VAT rates that are applicable. So you know the value of supply, apply the relevant rates on the value of supply. Now, before that, one more thing that we need to discuss, that is, what are the supplies that are liable at the rate of 0%. Now we know exempt supplies. On exempt supplies, we are not going to charge VAT. VAT is charged only on the taxable supplies. Taxable supplies of two types: supplies that are chargeable at the standard rate, supplies that are chargeable at the 0 rate. Now we are going to look at the supplies that are chargeable at the 0 rate. All the other supplies that are not treated as exempt supplies are supplies that are treated as supplies that are taxable at the standard rate. Now we will look at what these 0 rated supplies are. Part A. Goods shall be 0 rated where the supplier has exported such goods for which payment is received in foreign currency through a bank in Sri Lanka within a period of 6 months from the end of the taxable period of which such exportation has taken place. Basically, if you export goods, it is 0 rated, but you need to bring the foreign currencies in through the banking system into Sri Lanka within 6 months after the end of the taxable period in which the exportation took place. Right. When, as you all aware, we were recovering from a crisis, we are recovering from a crisis. When our exchange rates, when our local rupee was depreciating significantly, the exporters, what they did was they parked their export proceeds outside Sri Lanka without bringing them into Sri Lanka to get the benefit of the depreciation of the depreciating local rupee. To get the benefit, they parked their export proceeds outside Sri Lanka. So they were earning a lot, but the country is losing. So the government brought in this condition: if you want to apply 0%, bring the foreign currencies in through the banking system. You can't bring them through Hawala or Undial or any other means. Bring through the accounts, banking system, and you will be given only 6 months. Right? If you bring foreign currencies, then you can apply 0%. Right? If you don't bring, what will happen? If it is not 0 rated, if it is not captured under exempt supplies, what will happen? It falls under supplies that are chargeable at the standard rate. So bring foreign currencies or pay standard rate. That's what the government wanted to. Actually, that was not the intention. They wanted to encourage people to bring foreign currencies. Right. So goods are 0 rated when they are exported. Right. Second one, services shall be 0 rated where the supply of such services are directly connected with. So some specific services are given here. If the services are directly connected with any movable or immovable property outside Sri Lanka for payment in foreign currency within 6 months, the repair of any foreign ship, aircraft, or any merchant ship registered in Sri Lanka, or the refurbishment of any marine cargo containers, any goods imported into Sri Lanka for the purpose of re-export under inter-import trade for payment in foreign currency within 6 months, A copyright, patent, license, trademark, or similar intellectual property right to the extent that is a right for use outside Sri Lanka for payment in foreign currency within 6 months. International transportation, computer software development, and client support services, basically BPO services provided over the internet or the telephone. And also, finally, the provision of services to overseas buyers by a garment buying office registered with the SRT scheme for payment in foreign currency within 6 months. So some specific services are covered there. So in relation to these services, the applicable VAT rate is 0%, but that foreign currency requirement is there. You need to bring the foreign currencies through the banking system to enjoy the 0% on these supplies. So in addition to that, in relation to general supply of services, these are specific services that we discussed under B. Under C, we have any other service other than B above. Those are specific service. Any other service provided by any person in Sri Lanka to another person outside Sri Lanka to be consumed or utilized outside Sri Lanka shall be zero rated, provided that payment for such service in full has been received in foreign currency from outside Sri Lanka through a bank in Sri Lanka within 6 months. Can you remember similar provision that we discussed under exemption? If you provide the service to a person outside Sri Lanka, and if the service is consumed outside Sri Lanka, and if you are paid in Sri Lankan rupees, it was a exempt supply. But if you are paid in foreign currencies, and if you bring that foreign currencies through the banking system within 6 months, it is a zero rated supply. Right. So basically, those are the zero rated supplies. Now we discuss about the exempt supplies, that long list. We just discussed about the zero rated supplies. All the other supplies are subject to the standard rate. In the case of zero rated supplies, no tax shall be charged in respect of such supply. That we understand, because the applicable VAT rate is 0. Basically, we are not charging any VAT. The supply shall in all other respect be treated as a taxable supply. That's why we classified the zero rated supplies under taxable supply of goods and services. So as far as zero rated supplies and exempt supplies are concerned, there is no any difference as far as output VAT is concerned. We are not charging any VAT on exempt supplies, and we are charging 0% on zero rated supplies. Again, the output is 0, right? Output VAT is 0. So as far as output VAT is concerned, there is no any difference between zero rated supplies and exempt supplies. But I'll explain the difference between these two when we go ahead with the presentation. Right, question number 7. Determine the applicable tax rate in respect of the following supplies. Export of goods, subject to the condition that the export proceeds are brought through the banking system within 6 months, and you can assume that all the other conditions are met here. Generally, export of goods is zero rated. The applicable tax rate is 0%. Sale of goods to an exporter, can we apply 0% here? No, because this is not treated as a zero rated supply. It is not direct export, it is indirect export. Indirect is on indirect export, you can't apply 0%. So you will have to apply the standard rate here, which is 18%. Consultancy services provided outside Sri Lanka for payment in Sri Lanka. Consultancy services provided outside Sri Lanka. The service has been performed or the provided outside Sri Lanka. It is outside the scope of it. Right? It is outside the scope of it. Consultancy services provided in Sri Lanka to a client outside Sri Lanka for payment in foreign currency, and the service is consumed outside Sri Lanka. So all the conditions have been satisfied. Service has been given to a person outside Sri Lanka. He has utilized that service outside Sri Lanka, and payment has been received in foreign currency. So then we can apply 0%. Yeah, it's a zero rate of supply. Consultancy services provided in Sri Lanka to a client outside Sri Lanka for payment in foreign currency, and the service is consumed in Sri Lanka. Since the service has been consumed here, you can't apply 0%. It has to be a standard rate supply, 18%. Consultancy services provided in Sri Lanka to a client outside Sri Lanka for payment in Sri Lankan rupees, and the service is consumed in Sri Lanka. Since the service is consumed in Sri Lanka, you can't say that this is an exempt supply. If you want to claim the exemption, that the service should have been utilized or consumed outside Sri Lanka. Since the service is, in this case, is consumed here, you have to apply the standard rate, 18%. Right. Now, basically, we have now covered section 2. Now, if you go back and discuss, look at section 2 again, now you will have a better understanding. Since you will have the recordings at the end of this session, when you look at this presentation again, then you will look at with this knowledge that you have gathered during this presentation, so you will have a better understanding. So I'm not going to go back to section 2 again. Now, one of the adjustments now we are going to discuss bad debts. Now, as we discussed, when we compute our VAT payable, the time of supply plays a vital role. Now, as per the concept of time of supply, whether you receive money or not, you are liable to pay or liable to charge VAT. So there can be situations where the customers do not pay your dues. Sometimes they default not only the VAT component that you have claimed, but also the selling price. So you won't get anything. But when we do the VAT computation, you can't wait till you get the money, right? So you have to apply the time of supply concept and pay VAT immediately, even if you have not received the money. So there should be a mechanism to claim bad debts when we compute our taxes. So the Act has provided for that. If there is a bad debt that you have incurred in a taxable activity, you are eligible to deduct it from your supply. And you are entitled to deduct it from your supply. And if you recover it later, then you have to treat it as a taxable supply in the taxable period in which you recover, right? It's not a complicated adjustment. When you write it off, you are allowed to deduct. If you are able to recover it at the time of recovery of that bad debts, then you need to include that and pay the taxes again. In ascertaining the amount of tax payable and amount of tax on bad debt incurred in a taxable activity and which has become bad during such period shall be deducted. If any amount is subsequently received, the amount received shall be treated as a taxable supply during the taxable period in which it was received and shall be liable to tax. Question number 8. Based on the following information, compute the output VAT for the taxable period ended 31st December 2023. See the period 31st December 2023. You need to compute the output VAT. So when you compute output VAT, you have to take the value of supply and apply the relevant rate. 18% standard rate is applicable from 1st January 2024. This is before that. 31st, before 31st December 2023. The standard rate was 15%. Keep that in mind. And let's do this simple calculation. Sale of goods locally, 52.8 million. Export of goods, 15.3 million. Bad debts, local sales, 1.5 million. Export sales, 1 million. Recovery of bad debts of local sales, 1.8 million. Now take the value of supply, 52.8 million. Local sales, 52.8 million. From that, you can deduct the bad debts in relation to local sales, which is 1.5 million. And since the company has recovered bad debts of local sales amounting to 1.8 million, it has to be added to the value of supply again. So 52.8 million minus 1.5 million plus 1.8 million comes to 53.1 million. That's the value of supply, and apply 15% VAT rate. It is not 18, it is 15% because this is before 31st December 2023. So 53.1 million into 15% comes to 7,965,000. So that's the output VAT on standard rate supplies. Then we have exports. Export of goods, 15.3 million. Then we have bad debts as well. Export sales, 1 million. From 15.3 million, you deduct 1 million. It comes to 14.3 million. And apply the relevant rate, which is 0%. The output tax is 0. Right. That is basically how the bad debts adjustments are made. Right. Now we are discussing about the calculation part. Now we have discussed about the output value of supply, apply the relevant rate. Now we are going to deduct the input tax that we have paid. Right. Now we will look at what this input tax is. So basically we have two types of input tax. When we purchase goods and services from another registered person, when he sells goods and services, since he is a registered person, he will add VAT and sell. Then when we purchase, we will have to pay VAT on our purchases, local purchases. In addition to that, when we import goods into Sri Lanka, if they are not exempt at the time of importation, we will have to pay tax under section 2B at the time of importation. So that is also part and parcel of my input VAT. So we have two types of input VAT on local purchases, input VAT on imports. Input tax in relation to a registered person means the tax charged by another registered person on any goods or services to be used by such registered person in carrying out a taxable activity. The tax paid by him on the importation or purchase of goods which are used by such person for the purpose of making taxable supplies. So we have two types of input input on local purchases, and input on imports. Right. Now, these input taxes we can claim or set off against the output tax that we collect from our customers. A registered person is entitled at the end of each such period to credit for so much of its input tax as is allowable, and then to deduct such amount from any output tax that is due from him. Basically, your input tax can be deducted against your output tax. But, however, any person adopting a payment basis of accounting, that's the cash basis that we discussed under section 23, under special authority, if you are allowed to apply cash basis when we compute your output taxes, then you are not entitled to deduct all the input taxes from your output. You can deduct only the input taxes that you have paid in cash. If you take your output on cash basis, take your input also on the cash basis. However, any person adopting a payment basis of accounting is entitled to claim credit on so much of his input tax as is allowable only in respect of supply for which the payment of the tax has been made by such person. Right. Now, all the input taxes that we incur are not deductible. There are certain restrictions subject to which we can deduct our input taxes, right? So now we are going to discuss about the restrictions that are there in the VAT law when we are going to deduct our input VAT against our output tax. Any input tax attributable to the supply of goods or services received shall not be deducted in respect of the following. So these input taxes are not going to be are not deductible. Now let's take one by one. Input tax in respect of motor vehicles. Input tax in respect of motor vehicles is not deductible. Input tax in respect of motor vehicles other than, that means there are certain situations where input tax is deductible even on motor vehicles. So they are specified here from A to E, the situations where you can deduct your input on motor vehicles. So other than that, all the other scenarios, you won't be able to deduct your input VAT. Input tax in respect of motor vehicles other than motorcycles, bicycles, motor coaches provided by an employer for the transportation of his employees Sorry, there was a power disruption. Let me share my presentation. Hope you can hear me and see my screen.
Yes, sir.
Right. We were discussing about the restriction in relation to claim of input. Right. The second restriction is if the supply of goods or services received is not connected with the taxable activity or not included in the value of taxable supply, input tax is not allowable. Now, here we can explain the difference between exempt supplies and zero rated supplies. Zero rated supplies are taxable supplies. So if your input VAT relates to non-taxable supplies or exempt supplies, this input VAT you cannot deduct. But if it relates to a taxable supply, that is deductible. So that is where the difference is. In relation to zero rated supplies, input tax can be deducted. But in relation to exempt supplies, input tax cannot be deducted. So there is no any difference between these two as far as output VAT is concerned. So where is the difference? Difference is where input claim is restricted on exempt supplies. So your supply should be taxable, then only you are entitled to deduct your inputs. The third one, input tax not supported by a tax invoice or customs goods declaration. Now, as I told you, we have two types of input taxes. When you purchase goods and services locally, we have input VAT. And also when we import goods into Sri Lanka, we have input VAT. If it is a local purchase, we should have a document to support our input tax. That's called the tax invoice. We'll discuss about the tax invoice in a while. And if it is import, we need to support it with the document called the Customs Goods Declaration. That's called CUSDEC, or other authenticated document issued by the Director General of Customs. So we should have these two documents to deduct taxes from our output VAT. So if we don't have these documents, we won't be able to deduct it. And also there is a prescribed period within which we need to make this claim. After this period, we won't be able to deduct, even though we have these documents with us. Now, if it is a tax invoice, we have 12 months period from the date of the tax invoice to deduct it from our output VAT. If it is a customs goods declaration, we have 24 months to deduct it from our output VAT, right? If we don't make claim within this prescribed period, after this, we won't be able to deduct these input taxes against our output VAT. The final restriction is if the payment in respect of supply of goods or services referred to in subsection 1 of section 7, that is zero rated supplies, is not received in foreign currency through a bank in Sri Lanka within a period of 6 months. So what will happen? If you don't bring your foreign currencies, what will happen is it is treated as a standard rate supply, and also you will not be able to deduct your input taxes against your output tax. So basically you will have to pay 18% on the export proceeds if you don't bring the foreign currencies in. So basically those are the restrictions that are applicable in deducting your input taxes against your output tax. Now we will look at question number 9 with input output adjustments. The following information is extracted from the books of accounts of PQR Limited, engaged in the business of manufacturing of goods for the taxable period ended 31st March 2024. All transactions are given below are exclusive of VAT where applicable. Output, supplies to VAT registered persons, rupees 3.5 million. Supplies to non-VAT registered persons, rupees 2.5 million. On the input, we have import of raw materials, 3 million. Local purchase of raw materials from VAT registered persons, 1.5 million. Purchase of raw materials not supported with tax invoices, 1 million. Salaries and wages, 1.8 million. Calculate VAT payable for the taxable period ended 31st March 2024. I have given you the answer here. So first we need to compute the output VAT. You have to take the value of supply and apply the relevant rate. First we have supplies to VAT registered persons. So the values are given without VAT. So 3.5 million is the value of supply, and apply the relevant VAT rate 18%. The output VAT comes to 630,000 on that supply. Supplies to non-VAT registered persons, 2.5 million. Whether your whether your customer is a registered person or not, it doesn't matter. If you are registered, you need to charge VAT on your supplies. The value of supply is 2.5 million. Relevant VAT rate is 18%. The output VAT comes to 450,000. So the total value of supply is 6 million and output VAT is 1,080,000. Sorry. Now that's the output VAT. Now we have to compute the input VAT. Import of raw materials, 3 million into 18%, 540,000. Local purchase of raw materials from VAT registered persons. The value of purchase is 1.5 million. On that 18%, 270,000. Purchase of raw materials not supported with tax invoices. We know that this is not deductible, but still we need to show it under input taxes and deduct it from the input taxes as disallowable input taxes. So 1 million into 18%, 108,000. Salaries and wages, if you can remember, under taxable activity, employment has been excluded. So there is no VAT on salaries and wages. So the total input VAT comes to 990,000. So from that, this 180,000 is not deductible because we do not have supporting documents. We do not have tax invoices with us. Therefore, it is not deductible against your output VAT. So we are going to remove that. Deduct 108,000 and the allowable input VAT comes to 810,000. So you deduct that from the output VAT, 1,080,000, and the balance VAT you need to pay to the department, 270,000. Right. In the above question 9, in addition to the output mentioned, if the company has exported goods amounting to 750,000 and supplied exempt goods amounting to 1 million, compute the VAT payable for the taxable period ended 31st March 2024. Here we have additional 2 supplies, zero rated supplies and exempt supplies. So we will incorporate these 2 into our sum and see how we can compute the VAT payable. So first we need to compute the output VAT. Supply is liable at the standard rate that we have already computed. 6 million into 18%, 1,080,000. Then we take supplies liable at zero rate, exports 750,000. Relevant VAT rate is 0%, output VAT is 0. Then you need to take the total of these 2 to show the taxable supply, value of your taxable supplies. Taxable supplies, 6,750,000, output VAT on that is 1,080,000. Then we show exempt supplies separately. 1 million, there's no VAT rate on that. And then output VAT is also not applicable. Then the total supplies come to 7,750,000. Output VAT comes to 1,008,000. Now, we are going to deduct our input taxes. The allowable input tax that we calculated in question 9 is 810,000. Now we are going to deduct it here. Now, if you can remember the restriction, when you have exempt supplies, the input VAT, input tax attributable to that exempt supply is not deductible. Now, in this case, we need to compute the input tax that is attributable only to taxable supplies. So how we can compute this? Take the total common input that we have already computed, which is 810,000, and divide it by the value of total supplies, which is 7,750,000, and multiply it by the value of taxable supplies. So then we can compute the input VAT attributable to the taxable supplies. That's the amount we are allowed to deduct. So if you apply this formula and compute, you will get 705,484 as the allowable input VAT. When you deduct it from your total output VAT, it comes to 374,516. That's the amount you need to pay to the Inland Revenue Department. Right. We will quickly look at the implications. I'm running out of time. I will quickly run through because we will have the presentation, the recordings at the end of the session. Right. One of the keywords that we found earlier is a tax invoice. You have to have a tax invoice if you want to deduct your, if you want to make a claim for your input VAT. A registered person who makes a taxable supply shall issue a tax invoice within 28 days after the time of supply. If he has made a written request within 14 days from the time of supply stating that he is a registered person or is deemed to be a registered person. If your customer comes and say, I'm a registered person, I need to deduct the taxes you are charging from me, give me a tax invoice. We have to issue a tax invoice within 28 days from the date of, from the time of supply. Now, if he makes a request for the first time, then after that he is not required to make request because we already know that he is a registered person. However, where request has been made by a person after the receipt of the first supply, such person is not required to make any further request in respect of any subsequent supply. So this is important composition of a tax invoice. It is important to have this information in a tax invoice, otherwise it's not treated as a valid tax invoice and you won't be able to deduct your input tax against your output tax. So what are the details that should be there in a tax invoice? The name, address, and the registration number of the supplier. Right. Your name, address, and the registration number. And the name, address of the person to whom the supply was made. That's your customer's details should be there. The date on which the invoice was issued and its serial number. There should be a serial number and the date should be there. The date of supply and description of the goods or services that you can understand. Quantity or the volume of the supply. The value of the supply, the tax charge, and the consideration for the supply. Value of the supply should be there separately. Tax charge should be there separately. And the total consideration should be there separately. And the words tax invoice. The words, it should say that it is a tax invoice, right? Otherwise, it is not a tax invoice. Right? This details should be there in a tax invoice. Tax invoice on imports. As I told you, when you import goods into Sri Lanka, the customs goods declaration or any other document authenticated by the Director General of Customs shall be treated as a tax invoice. Then we have retaining copies of tax invoices. The original tax invoice, you have to give it to the customer, because based on that he will make his claim, and you should keep a copy, duplicate, for a period of 5 years after the expiry of the taxable period in which the invoice was issued. After issue the invoice, keep a copy of the invoice for 5 years period. The original you need to give it to the customer. Issue of copies of tax invoices. It is not lawful to issue more than one tax invoice for each supply. If a registered person claims to have lost the original tax invoice, the person who makes the supply may issue to such registered person a copy, clearly marked copy only. Now, if your original invoice, tax invoice is misplaced, you can ask for a copy. If you ask for a copy, the supplier can't give you another original. So what we will do is he will issue a duplicate or a copy, marking it as a copy. Based on that, you can make your claims. Issue of non-tax invoices. If you are a registered person and when your customers are not registered person, you don't have to issue a tax invoice to them, because they are not going to make any claim on their purchases. So you just need to issue a commercial invoice. There you don't need to show the VAT component, consideration, value of supplies separately. You just need to show the consideration, including the VAT amount. So it is not treated as a tax invoice. You can issue a commercial invoice in that case. Now, filing of VAT returns and payment requirements. Every registered person is required to furnish the VAT return not later than 1 month after the expiry of each taxable period. After the end of the taxable period, you have 1 month's period to submit your tax return, showing your output separately, input separately, the claims and payments and all that. You would have seen all these VAT returns. So it has to be submitted within 1 month after the end of the taxable period. So how to pay the taxes? The difference between output and input. If it is monthly taxable period, don't know before 20th day of the following month, you have 20 days after the taxable period to make the payment. If it is quarterly taxable period, you have to make the payments on monthly basis. The first month payment should be made, don't know, before the 20th of the following month. That means in the second month payment, don't know, before the 20th of the third month. The quarterly payment or the balance payment for the quarter for the taxable period should be made within 20 days after the end of the relevant quarter. Right. Now we have come to the final part of our presentation, that is simplified value-added tax. Right. Before we move in, let me give you a brief introduction as to why this was introduced. Now, as an example, if you take zero-rated suppliers, when they are exporting goods, the applicable VAT rate on their supplies is 0%. That you are already aware. So their output VAT is always 0. But when they purchase goods and services, or when they import goods into Sri Lanka, they have input taxes. So their output is 0, they have input taxes, they will always end up with a refund. So the government has to pay it back to the exporter, right? So the exporter has to claim it from the department. So even when we apply for a when we apply for a refund from the department just can't release the refunds. They don't know whether we are making a genuine claim or not. So they will have to do an audit. And also they will have to make sure that the person who has collected taxes from us has actually paid to the department or not. So after all these verifications only, they can release the refunds. So that is going to be, it takes a considerable time. So it is the exporter's money that is going rounds and rounds and rounds. So the exporter doesn't have cash to run his operation. So his cost of finance go up, right? So to cover that, what we'll have to do is we'll have to increase the prices of its goods that he is exporting. Then he won't be able to compete in the international market when the prices are higher. So what will happen is this VAT system affected the export industry or the persons who are making zero-rated supplies badly. So the government came up with system called a Swat scheme to simplify this operation and minimize the VAT refunds. So under this system, we have two types of registration. Those who are entitled for refunds can register as RIPs, registered identified purchasers, and those who are supplying to these RIPs can register as suppliers, registered identified suppliers. So we have two persons registered under a SWAT scheme, registered identified purchasers and registered identified suppliers. Now we will look at who are the persons who are entitled to register as RIPs. The following persons registered under a SWAT scheme are called registered identified purchasers. Exporter of articles or services. As I explained, if you are making zero-rated supplies, you can come under this section, come under this scheme and register as a RIP. Registered persons engaged in any strategic development project. Registered persons engaged in any specific project. Suppliers who provide value-added services to an exporter. Persons registered under Section 22(7) of the Act that we discussed under taxable period, long-term projects. And any registered person who supplies any goods or services to any registered person mentioned above, if the Commissioner General satisfied that the value of such supplies exceeds 50% of the total supplies of such supplier. Now, let's say you don't fall under any of the categories from A to E, but you are supplying to these persons. Now, let's say you are supplying to an exporter. The value of your supply is more than 50% of your total supplies. Then you can also come under this scheme as a registered identified purchaser. Registered identified suppliers are those who are registered under this scheme and who are supplying goods and services to RIPs. Those who are supplying to RIPs are called registered identified purchasers. So how does this operate and how does this minimize the VAT refund, VAT refunds? So first, what will happen is all these those who are entitled for refunds should register under this scheme as RIPs. Once they register as RIPs, they will be given a document called SWAT credit vouchers. SWAT credit vouchers, right? So that will be given by the department, Inland Revenue Department. So those who are supplying to these RIPs, they will issue, when they supply, they will issue an invoice called suspended tax invoice. It is not a tax invoice that we discussed earlier. And also it is not treated as a tax invoice for the purpose of VAT. So they will issue an invoice called suspended tax invoice when they are making supplies to RIPs. Then RIP, but what he will do is he will issue a SWAT credit voucher that was given to him by the Inland Revenue Department. He will mark the supplies that he has purchased and the VAT component, everything he will write in that voucher and he will give it to the RIS, right? So there is no any cash transaction. RIP does not pay the VAT component in cash. Instead, he issues a SWAT credit voucher, right? There is no any cash involvement. His output VAT is 0. Exporter's output VAT is 0. His input tax has not been paid in cash. So refunds will not generate there. So that is how it operates. And if you register under the normal VAT scheme, and if you do not come under this SWAT scheme as RIS, you can't issue suspended tax invoices, right? You must be a RIS to issue suspended tax invoices and accept SWAT credit vouchers from the RIP. And if you are RIS, make sure that you collect all your credit vouchers from your RIPs on time, because otherwise, that's a part of your output VAT. That's a part of your output VAT which you have not collected in cash, right? For that, you have received a credit voucher that you need to submit to the department, saying that I have received this much of credit voucher, so I'm not, since I have not received cash, I'm not going to pay that in cash. I'm going to hand it over to you and deduct from the total VAT that I am liable to pay. That I will we can discuss in the next session. So you need to you have to make sure that you collect all the credit vouchers on time. Otherwise, you will have to pay that VAT component also in cash to the department. And if the RIP uses the suspended purchase for other purposes other than the specified purpose, it should be treated as a taxable supply. Now, this is also a special authority given to the RIPs to suspend and purchase to avoid refunds and all that. So that is given for a specific purpose. So if they misuse these credit vouchers and if they do something else to purchase other purchases, then the tax that has been suspended has to be payable by the RIP. So it should be used for the specified purpose. Now we will look at the final question on value-added tax with SWAT implications as well. A Limited is a VAT-registered company engaged in the business of manufacturing bags. The company is also registered under SWAT scheme as a RIS. So it's not RIP, it's a RIS. The following information is given for the taxable period ended 31st March 2024. Turnover is given exclusive of VAT. Local sales 6,084,000. Sales to exporters under SWAT scheme 1,716,000. Input VAT on imports and local purchases rupees 543,000. On repairs to motor car used by the CEO 24,000. The company has collected SWAT credit vouchers of 308,880 on its suspended supplies. Right here, this company has suspended and sold to exporters under the SWAT scheme, and from the exporters, the company has collected SWAT credit vouchers amounting to 308,000. So we need to calculate the balance VAT payable for the taxable period ended 31st March 2024. Now, this is the answer. First, we need to compute the output VAT. On local sales, 6,084,000. We apply the normal tax rate 18%. Output VAT comes to 1,095,120. Suspended supplies, those are the supplies we made to exporters. Value of supply is 1,716,000. Standard tax rate 18%. Output VAT comes to 308,880. Taxable supplies, we take the total of the local sales and suspended supplies, 7.8 million. Output VAT comes to 1,404,000. Now we are going to deduct our input taxes. On imports and local purchases, 543,000. There's no restriction that we can deduct. On repairs to motor car used by the CEO, if you can remember, the first restriction when we deduct input taxes from our output tax. Input tax in relation to motor vehicles is not deductible unless they are specifically allowed in certain circumstances. But it is not a situation where that is deductible. So on repairs to motor car used by the CEO, we know that it is not deductible, but show the amount under input tax, it is 24,000. Total input comes to 567,000. But out of these 567,000, 24,000 is not deductible because it is related to a motor vehicle used by the CEO. So we deduct 24,000 and the allowable input tax comes to 543,000. So we deduct that from the taxable supply, from the output VAT. So the VAT payable comes to 861,000. Do we need to pay this 861,000 in cash to the department? No, we don't, because we have not received 308,880 worth of cash on our suspended supplies. If you look at the output VAT component on our suspended supply is the same amount, right? So since we have not received that VAT component in cash, and we have received or we have collected the credit vouchers from the RIP, so we are not going to pay that component in cash. We are going to deduct that component against the total VAT payable. So we deduct the value of credit vouchers from the output, from the total VAT payable. So the balance VAT payable comes to 552,120. That's why I ask you to make sure, if you are RIS, make sure you collect the extra credit vouchers on time. If you don't, if you have not collected this 308,000, you won't be able to deduct it. When you are not allowed to deduct, the amount payable will go up. So unnecessarily, you will be paying more taxes. So basically, that's about the presentation today. I have taken about 30 to 35 minutes more because actually I wanted to include the new developments also. Right, if you, that's about the presentation. If you have questions, please feel free to raise.
So students, if you have any questions, clarifications, you can ask.
Yes, sir.
One small correction. The bad debts you said, the example that you took, that was at the rate of 15%. Bad debts deducted can remain.
Yes.
Thereafter, the rate is increased to 18%.
Yes.
So when bad debt is recovered, what is the rate applicable? Is it 15?
I didn't want to complicate it. That's why I took that period. Now let me explain. Let me explain. Now, if when you write it off, it should be treated. Now, if you write it off before 31st December, and you can deduct it during that period. The tax rate is 18%. When you recover it, the excess you will have to consider that as a taxable supply in the taxable period in which it is recovered. So if you recover it after 31st December last year, if you recover it now, when you recover it, the applicable VAT rate you need to apply on the recovery.
That is 18%.
18%.
Okay. Okay, so thank you. Okay, Natasha, miss.
Yes, sir. Okay, so thank you. So on behalf of the Department of Accounting and the lecture panel of this taxation course, including Udeshanta sir and Isuru sir, I would like to thank Mr. Nadika Suranjana very much for his invaluable contribution for this guest lecture. So I personally know he wanted to finish the full content with the recent developments without skipping the areas. That's why he even took extra time and completed the lecture. That is really appreciated, sir. It was really a fruitful discussion for me and as well as the students. So thank you very much for your contribution. And not only this year, last year also you joined. So we really appreciate your continued support as well. Thank you very much, sir.
You're most welcome. And as I told you, it has always been an honor to make this discussion. So thank you very much for this opportunity. And let me thank Udeshanta sir. He has always working with me. I mean, as a lecturer, as a father. So thank you very much, and also the team at the department, and also thanks for joining all the undergraduates. And let me wish you all the very best. Thank you very much, and have a wonderful weekend ahead. Thank you very much.
Okay,
Thank you very much.
Nadik sir. Good night.
Good night.
Good night, sir.